Define the major market centers of the secondary markets. Define the major market centers of the secondary markets. The market centers, the locations, both physical and electronic, where buyers and sellers may gather and place trades are called market centers. The secondary markets in the United States have four types of market centers: the exchanges, OTC, NASDAQ, and the ECNS. Exchanges. One market center is the exchanges. The exchange market is composed of the NYSE and other exchanges on which listed securities are traded. This market is also known as an auction market. The term listed security refers to any security listed for trading on an exchange. The NYSE is the largest of the exchanges and is the model used for the exam. Each stock exchange requires companies to meet certain criteria before it will allow their stock to be listed for trading on the exchange. The exchanges are defined primarily by their physical location and pricing system. Physical location. One of the defining characteristics of exchanges is that they have a physical location, often called a floor. This is not as universally true as it was in the past, but it is still a point of difference from the OTC market. Members, not employees of the exchanges, transact business trades on the floor of the exchange. Pricing system. The exchanges are sometimes called double auction markets because both buyers and sellers call out their best bids and offers in an attempt to transact business at the best possible price.
The members of the exchange are as follows. Designated Market Maker DMM. The Designated Market Maker DMM, sometimes called a specialist, is the member that acts as the dealer on the floor for a specific security. The DMM maintains an inventory of the security and guarantees liquidity. The DMM is responsible for maintaining a fair and orderly market in the assigned security. Floor brokers represent their firm and their firm's clients on the floor. If your customer places a trade that will execute on an exchange, a floor broker will handle it. $2 broker. If the floor brokers become overwhelmed by trades, they enlist the services of the $2 brokers. These members place trades for the floor brokers and receive a fee for performing the service. Floor traders, also registered floor traders, FTs, or FTs are members that buy and sell on the floor for their firm's accounts, not outside customers. They help maintain liquidity on the exchange. Test topic: allo trading on an exchange happens between the members, not between employees. Employees on an exchange support the exchange and its members but are not involved in trading. Take note that there are over a dozen registered exchanges in the United States. Though the rules of each vary, they perform trades in much the same fashion. The test uses the NYSE as the model for exchanges.
The over-the-counter OTC market. Another market center is the OTC market. OTC markets also have criteria that a company must meet to be traded on a particular OTC venue, just as exchanges do. Historically, these criteria were not as stringent as those imposed by the exchanges, but over time, the quality of many issues traded OTC has closed the gap with exchange-listed companies. However, the OTC market continues to be the market center for smaller companies. The OTC market trades unlisted stocks, as well as most bonds, including municipal bonds and treasury debt that trades in the secondary markets. Take note, most corporate debt issues trade OTC. There are a small number of corporate debt issues that trade on an exchange, but that has not been a test topic. OTC trading occurs between market makers in a decentralized electronic market. There is no physical location or floor in the OTC market. A market maker is ABD that maintains an inventory in a given security and buys and sells the security throughout the day. The OTC market maker's function is very similar to the DMM on the exchanges. However, in the OTC market, there are multiple market makers dealing in the same security and competing to attract orders from BDIS. When a customer places an order with ABD to purchase or sell an OTC security, the broker chooses a market maker, also called a dealer, to complete the trade. The BD, who represents the client, chooses a market maker to get the customer a fair price. When a customer sells a security in the OTC market, the customer is selling to a dealer through the BD at the bid price. So, that means the dealer is purchasing at the bid from the customer. A customer that buys a security in the OTC market is buying from a dealer through the BD at the ask price. So, that means the dealer is selling at the ask to the customer. The difference between the bid and the ask is the spread, and it represents the market maker's income. Quotes in the OTC market represent the highest bid and lowest ask posted in the system. Note, the concepts bid, ask, and spread are covered in more detail in the lesson on trading.
The third market, Nasdaq Intermarket. Another market center is the third market, or Nasdaq Intermarket, a trading market in which exchange-listed securities are traded in the OTC market. BDs registered as OTC market makers and listed securities can do transactions in the third market. All securities listed on the NYSE and most securities listed on the regional exchanges are eligible for OTC trading as long as the trades are reported to the consolidated tape within 10 seconds of execution. The fourth market, the scenes. The last market center is the fourth market, a market for institutional investors in which large blocks of stock, both listed and unlisted, trade in transactions unassisted by BDs. These transactions take place through electronic communication networks, e-scenes. E-scenes are open 24 hours a day. Take note. The dark pools, sometimes called dark pools of liquidity or simply dark liquidity, is trading liquidity that is not openly available to the public. The bulk of this volume represents trades engaged in by institutional traders and trading desks away from the exchange markets. Generally, these are large volume transactions. Institutional trading desks that choose to use dark pools are able to execute large block orders without impacting public quotes or price, or revealing their investment strategy regarding any of their holdings. Additionally, orders can be placed anonymously so that the identity of the entity placing the order is unknown to the general investing public, along with the volume and price for the transaction. The concern with dark pools is that some market participants are left disadvantaged because they cannot see the trades, volume, or prices agreed upon within the pools, and thus, market transparency is darkened. Take note. Trading hours: the NYSE trades between 9:30 a.m. and 4 p.m. ET each business day. Normal hours for retail OTC trading are the same as those of the NYSE, although many market makers remain open until 6:30 p.m. in extended hours trading. The after-hours market is much less liquid because order flow is limited. As a result, the spreads between bid and ask prices are wider and there is greater price volatility.